Okay, so what do you guys think? What's the answer to that? How many stocks is in the S&P 500? Not 500. Yeah, any guess?
2000?
No, that's a different index. No. It's 503. There's a 503. And what's S&P 500 stands? Like, what's that mean? Yes, but like, my guess is like, what are the stocks in there? Like, what made those stocks into that index?
Small cap.
Public?
Opposite of the small cap. It's a 500. It's 500 largest capitalization of the stock. What that means is the capitalization. You probably heard people talk about like small cap, large cap, mid cap. What does cap mean? The cap means the stock price of the company times how many shares that's out there. So that's what that means. So the bigger the company is, the more shares, the higher value of the stock is. Maybe you don't have as many shares out there. So that's what. So that's what that index is.
Who's number one?
I don't know on top of my head, but it's right now 7 of the main stocks that weighs more than 20% of the S&P 500 index. It's like Apple, Facebook, Amazon, Microsoft, Tesla may or may not be in there. Tesla recently just made into it. Tesla wasn't in S&P 500 for a long time because it wasn't even profitable till like maybe 2 years ago, something like that.
SpaceX going public?
They're doing the first round of IPO, so they're not really like public yet. What IPO means is initial publishing offer. What that means? So it's like companies they buy and sell on the primary market. Like yeah, I don't really have anything prepared for today. It's more like I want you guys ask me questions because I know there's lots of crazy stuff happening on the market. Especially with the war going on and the stock price go up and down for the past month. So I just want to show you guys this about long-term investing. So this is a picture of the history since stock market established and till nowadays. So you can see if you guys have any specific time, I can zoom in and show you guys. It doesn't matter. Okay, so let's start with 2008. Okay, so 2008 financial crisis. Is the biggest? Okay, where's the bar? Anyway, so 2008 is right here. The market. So this bottom line is all the president in the history, and this number here is the ending year balance of the Dow Jones point, like where the market is at. So 2008 is close at 8776. But if you didn't cash it out, you hold whatever you had in the market, and you wait just one more year in 2009 market when closed at 10,428. So it went right back. Famous year COVID, right? In 2020 is when all the stock market crashed and all that. It was down so bad the market was actually had to close on the trading day to prevent it from keep dropping. And we ended that year. It was right here. So right here you can see 2019, the year before COVID, is 28,538, and the 2020, the year of COVID, with all that market drop in March, April, the market still closed at the December 28,586. So that's even higher than the year before. And you can see it doesn't matter it's Democrat or Republic, doesn't matter who is in the house, the market goes up. You can see like there's lots of fluctuation. But when we invest, we always focus on long term, right? So let's say if you are in your 30s, 40s, you invest for your retirement. You don't need that money till you are 60, 70. You got at least 20, 30 years time frame. Yes, the market might drop this year, but it doesn't matter. It will come back. If you look at any 20, 30 year frame, the market is always comes back. And In fact, in the history, there isn't any 2 years market had a negative return. So market always come back the year after that. Here is kind of like, so if you had $1, if you invest $1 from 2026, how much you would have in 2025?
2006. 2006.
Yeah, 2006. Yeah, if you had $1 in 2006, what's that's gonna look like until 2025? So that's about 20 years. So you can see U.S. large cap stocks, your dollar turned to $8, small cap 4.8, and if you just had that cash, you lost money because inflation will put you at $1.64. And if you just have cash sitting in the bank, then you actually lost money compared to inflation. Other thing, so real life story, I have a client, he is adorable, he is 99 years old, going to be 100, used to be a UC Davis mathematics professor, and he recently just published another book about calculus. But anyway, his wife used to work from Warren Buffett, the company, and they had 1 share of Berkshire Hathaway stock A back in 1989, and they hold on to it. Her cost base is $19. Anyone know how much that stock is right now for 1 share, just 1 share?
It's $35,000.
Nope. It's 700. I was just looking it up. Yeah. It's $722,000 for 1 share, just 1 share. Yeah.
$722?
722,000.
Oh.
Yes. Yes. No. Yeah. 722 share. 722,000. Yes. Yeah, and then the cost base is $19. What that means, if they're gonna sell that stock, they're gonna pay tax on almost $720,000. They're probably gonna, it's gonna be long-term capital gain, max at 20%. So 20% of that, but that's gonna be something they hold till they die. We're gonna have a cost-based step up, so the kids is not gonna pay any tax, and we can diversify that portfolio. You can do a minor Roth IRA. So lots of business owners, they do like minor Roth IRA for their kids. They will pay the kids a salary. It's so low they don't even pay payroll tax, but it's also business tax write-off, and they put that money into their kids' Roth IRA account. It's called minor Roth, so they can start tax-free investment before they even like 18 and all that. Or you can just do a regular custodian account. The problem with regular custodian account is you don't have control over when the kid is 18. So that becomes their money, it's under their name. You will completely remove it off the account. So it depends on how you train your kids, how much do you trust the kids. Yeah, the last thing is market timing doesn't work because you never know when is the best day of the market till you already missed it. So this is just shows you what's gonna look like if you invest $10,000 in the S&P 500 at the beginning of 1996. The first one is you just ride the market. You consistent investor, you didn't cash it out, and you didn't miss any best day of market. You have an annual return of 10.4%. That will bring your balance to $192,000. If you miss just 10 of the best days, you dropped to annualized return of 7.4. That's almost half of what you could make in the market.